Allison LaForgia, managing editor of HousingWire's content studio. And on this episode of 10-Minute Talks, I'm with Jennifer McGuinness, who's the CEO of Pivot Financial. And I'm going to pick her brain about what's going on with the industry. So Jennifer, thank you for joining me today.
Thanks for having me. Glad to be here.
So I'm so excited that you were willing to give me time today because I feel like your LinkedIn is sort of myth busting for the industry.
Okay.
And I find it to be really refreshing because I think that sometimes, a lot of times, most often, your take is just talking about what we should actually be talking about instead of screaming about headlines.
Yeah, I'm not really a drama queen. I think most people know that. I'm more of a factual base, let's do the work, figure out what the right answer is. And after you do the work, if I'm wrong, I'll be happy to say that I'm wrong. So far, I'm not wrong. And if we want to call it myth busting, I'm good with that. I think it's just more about, let's see what we're supposed to be working on.
Right, and I think that's clearly one of the reasons you've been everywhere recently. I mean, you have this crazy travel schedule coming up. You moderated a panel yesterday at MBA servicing. Talk to me a little bit about that panel where you were talking about non-agency servicing.
Yeah, so the panel yesterday was actually very complex and in-depth. We did unique challenges of non-agency servicing. And one of the things I really wanted to get across on that panel is non-agency does not mean non-QM. And not every non-agency product is non-QM. Heck, not even bank statement loans are not always non-QM. So, we chatted with 4 leaders from different servicers, Face Servicing, BSI, PHH, and Davamule were on the panel. And it was, the 5 of us really digging deep. And we had an interactive audience. There was a lot of Q&A. And we touched upon DSCR, bridge, fix and flip, ground up construction, first and second lien HELOC, closed end second liens, and also HEI agreements. And, where the pitfalls are for servicing, what are the challenges, and also, in originating those loans. They're not bad products. I think a lot of people put anything non-agency in a riskier category. Actually, they're not riskier if you're originating a good loan with good credit thought process. And, I really was interested in helping to have that discussion. And we had a cool audience for it.
It sounds like the audience really liked it. I know that our newsroom was very interested in talking to you afterwards about some of the insights that came out of that panel. But I want to continue in sort of that myth-busting lane, because I know that you said your LinkedIn's not meant to be a myth-busting source, but even as you just mentioned, talking about people maybe viewing things as particularly risky that aren't if they're done correctly. What are some trends that the industry at large should be focusing on instead of noisy headlines?
So I think on the loan side of things, diversification. We've been bottled up so much in an agency-only world for so long now. Sell all your loans to the GSEs or sell them to an aggregator so they can deliver them to the GSEs. And we've seen a lot of pickup now. Jumbo has increased by 15%. Non-QM is now 13.5% to 16% of the market, where just a short while ago it was 2%. And again, though, non-QM, the way that it's classified, I love all my analyst buddies, but they're classifying as non-QM. It's just non-agency products. The other thing is a DSCR loan is not a non-agency consumer-facing product. It's actually a resi commercial hybrid loan. So I think you want to keep that in mind. But all of these products are necessary to service your borrowers most effectively and efficiently. You may have a borrower that's just outside of a GSE qualifying. Well, there is a product for that, and it's generally literally a cuspy agency product. And those borrowers don't have to have 50 back-end DTIs in order to, need that product. So I think that's important. I also would like to see other loan structures come back. There is a time and a place for an interest-only payment, and that's not evil. That's necessary for certain borrowers. And I'd like to see more creativity come back into the market, just not in a silly way. For example, I'm going to talk about something from yesteryear, the pay option arm, the evil loan allegedly. It wasn't evil for who it was originally designed for. It's when the market started giving it to everyone that it became a problem. So again, you rein in the product for the customers that you create it for, you deploy it that way, and you do it effectively and efficiently, and you have good products.
So specializing the borrower with the product that is most apt for them. And it's interesting that you say that, because a couple of months ago, I think at this point over the summer, I was talking to Clayton Collins, our CEO, and Clayton said that he thought the age of the vanilla borrower was dead.
He's not wrong. I mean, there's still a lot of borrowers that fit into a standard agency type product, but there are other borrowers, especially with the rise of remote work. There are a lot of people that have more than one job. Certain jobs are differentiated types of income. You may have one job that's W-2, another that's 1099, another one that's off the books. And that's not the easiest thing to underwrite in a W-2 tax return kind of way. And you may need to do alternative documentation, but that doesn't mean that you are a riskier borrower. It means that you have complex income streams. And that's not necessarily a bad thing. That's somebody who's diversified. That's somebody that in a doomsday scenario, if they were to lose one of those jobs, is employable in many ways. So in some ways, you really want to look at that borrower as an upside. So I agree with Clayton. I disagree that the vanilla borrower is dead. I would say that there are still vanilla borrowers, and then there are also, chocolate, strawberry, and pistachio ones as well.
I think that's a great take. I think we were talking largely about like the standard, what you would see in ages past, where you had like a simple W-2. Here you go. This is my one income. This is what I want. This is my standard loan. You have this standard closing process. So I think
Understood.
I think in that application, it's probably a little more fair. But to your point, I definitely think that agency, the traditional products that we see most for a large portion of borrowers, are going to continue to clearly be popular.
Look, I mean, if you can qualify for it, most people are going to continue with it. However, I think some of the other things that are going on in the market could change that. For even higher FICO borrowers, when all of a sudden LLPAs have to shift in order to accommodate certain nonsense going on in the market right now. And, I'm hoping we won't get there, but, we'll see.
Speaking of certain nonsense going on in the market right now, I would be remiss to not ask you a question about what people should actually be paying attention to in the conversation about credit.
Okay, which aspect of credit should we touch upon?
Let's talk about the credit score piece, because I think that's something that we're debating heavily right now as an industry.
Sure. No, I mean, look, I think how did we end up here, right? There was an executive order that was signed by the Biden administration saying we need competition in credit scoring. They felt that there was a monopoly with FICO, and, fast forward, all of a sudden, 9 months ago now, approximately, Vantage gets approved next to FICO Classic, which makes absolutely no sense. And the reason it makes absolutely no sense is in 2022, both FICO's newer model, FICO 10T, and Vantage 4 were actually approved side by side by FHFA, and they put out that notice, right? So now we sit here and we have a older scoring model that's allegedly going to be used next to a newer scoring model, and that doesn't make business sense. In addition, we're now 9 months later and it's still not rolled out. So why are we still talking about it? Has a decision been made, for example, to put pencils down? I'm wondering, and I'm sure everybody else is. But let's say we move in that direction. I think there's a lot of things that have to be taken into consideration. What was the other thing that came out from FHFA and the GSEs? Lender choice. Lender choice was defined by them as pick one or the other, FICO or Vantage. It was not defined as run all of the scores and pick the highest one. But one of the biggest messages going out in the market right now is, yay, we'll just pick the highest, credit score. And it's like, no, that's not what the intent of lender's choice was. But even if that's okay in some way, in someone's mind, are we doing the right thing for credit by doing that? And the answer is no, okay? The whole reason the tri-merge exists is credit reporting in general by creditors is actually voluntary. So they don't have to do it.
You rocked my world when I read that in a LinkedIn post. It, I will tell you, genuinely blew my mind as a concept.
Yeah, they don't have to report. They don't have to report consistently. They don't have to report to all of them. They don't have to do anything, right? So the only way right now to truly get a full picture or the fullest picture possible is to actually have a tri-merge. In theory, you could do a bi-merge, but you'd still have to select the right bureaus for that. and do significant testing. But overall, the right answer still is the tri-merge. Now, if we move to a place where all of a sudden it's mandatory to actually report to every credit bureau and this and that, now you could actually create real competition with the credit bureaus, because now they'd all in theory have the same data. Who can present it best? Who can give it to me the fastest? What's the best analytical way to look at this, et cetera? But are we going to get there anytime soon? No. Okay, with regard to MBA's request for single pull, we've done a significant amount of research at Pivot, and so have a vast array of research firms. Right now, there's a large discrepancy between the different credit scoring models. I've seen research that, varies everywhere from 5 points to 61 points of deviation, and it's all, against a bell curve and a normalization. But at the end of the day, even 10 points can move the needle on your LLPA categories, 20 points, sometimes multiple categories or category and a half, et cetera. So what is the point of a credit score? Predictability of default, okay? So if all of a sudden we have different scoring models pushing scores higher, right? Are we now going to be able to use historical modeling to make assumptions about how loans will perform in the future? And the answer is no. One, there is no historical in general for one of the two scoring. The other is we have more data now available in FICO 10T, and I really think that needs to be taken into consideration. It's kind of like, hey, do you want to work with, the company that's been around for, 30, 40 years, has been refining these models for 40 years, right? Or do you want to work with the company that, was looking over their shoulder as being a partner to them, at times were limiting the other entity, and now they've decided to create a scoring model so that's a real monopoly. When you take 3 credit bureaus now own the credit score, that's, what's the word they're using? Oligarchy, I think, right? That's an oligarchy. FICO is an independent entity. The 3 bureaus are 3 independent entities. You have 4 entities today. Are they cornering the market on scoring and actual data? Absolutely. But where's the company that stood up and said, I'm going to take them on? And, Advantage isn't it, because that's still these same 3 dudes, right? So I think you want to keep that in mind as well.
It's interesting because I feel like that's sort of glossed over as an additional talking point that the 3 bureaus own Vantage. And it's interesting even to see people, the more that they read, the more that they understand the conversation that we're having. But I do feel, and what I appreciate you talking to me about, is helping refocus our audience on what they should be paying attention to instead of all of the noise and this person having one take and this person having another
I think
take.
the noise is very real. I think that the credit bureaus and also Vantage have been riding a wave of, the 1,400% alleged pricing increase by FICO. They've actually increased their pricing more than FICO has in the last few years. And again, this is just doing the work, right? But the thing that nobody talks about, it wasn't something I wrote on LinkedIn, and is why FICO had to increase their pricing. They were stuck in a level pricing agreement for more than 20 years with the credit bureaus. The credit bureaus, to have a scoring model partner, literally kept them that way for more than 20 years. Now, at HousingWire, right, would you be okay with, having to keep your pricing, your compensation, your subscriptions, everybody's salary, et cetera, static for more than 20 years?
No,
Do you think
it's
that
insane.
my BFF Clayton would be okay for having to cover costs at a flat dollar level for a 20-year duration? And do you think at year 20 and a day, he'd be like, okay, now I've got to actually get back some of this money that I've had to put out for this duration of time? Because inflation is real, costs change, et cetera.
And data is significantly more complicated
right
now.
And it's almost like, the bureaus created this narrative. And if you look at and I'm not against Vantage, I've never, waved a flag of who I'm in love with, quite frankly. But my point is that fair? And then right at the end of that 20 plus year timeline is when Vantage was launched, right? It's almost like the message was created on purpose. And I don't like seeing that.
That is very interesting food for thought. And I think when you look at it in that context, you have to understand that, of course, the price will change. Like I said, data is more complicated. A flat fee for 20 years is absolutely insane. When you look at, if you looked at what houses cost 20 years ago, what houses cost now. And
It's a
same
common
thing.
sense thing, right?
Yes.
Businesses have to stay in business and they also have to be able to cover their costs and make money. None of these organizations we're talking about right now are nonprofits, nor have they ever been. So, again, I think you want to look at what are the fact patterns that led to these results. There was no stub on the credit bureaus, and they were raising their prices the entire time, but yet keeping other cost bases suppressed, right? More importantly, though, than the cost, I think, is what makes up these models. And, in the deep dive research that my research team has done, there are material deviations in these models. I've got an issue with, for example, they have a prime credit score category, Vantage, and the baseline on the bottom number on that credit category is 661. A 661 borrower has never been a prime borrower in any market. And, I think that if we're going to work with Vantage at some point in the future, I think they also need to learn about the mortgage industry and classify accordingly, right? And I think that that's really important as well.
Well, Jennifer, thank you so much for giving me time this morning. I appreciate you helping me and our audience read between the lines and help us align our priorities to what we should be paying attention to.
I appreciate that and always thankful for the opportunity. And thank you to HousingWire.